The tax law passed back in the summer of 2025, known as the One Big Beautiful Bill Act, provides some new tax deductions for seniors. This part of the tax law is commonly being referred to as the new Senior Bonus Deduction, and it applies to folks age 65 and up. But the way that it works is also creating a new tax trap for folks, or another way to put it is an artificially high tax rate if your income falls within a certain range. I'm going to break it down for you today. Let's get going. Now, let me start by just touching on the key elements of the new senior deduction. I'll throw a slide up on the screen here. Again, this is for folks age 65 and above. Single tax filers get an additional $6,000 deduction so long as their adjusted gross income or their gross income is $75,000 or less. For married filers, the deduction is $12,000 as long as their gross income is $150,000 or less. Now, what is creating this tax trap that I alluded to in the intro? Well, the answer is these deductions are subject to phase-outs, which means when your income exceeds these thresholds, the deduction starts to go away. And the phase-out range for single filers, you can see here, is between $75,000 and $150,000, and for married filers, it's between $150,000 and $250,000. So what happens when you get above these thresholds with income is that income gets taxed at the corresponding tax rate that it would otherwise be taxed at, but it also results in a loss or a partial loss of these bonus deductions. So you get this 1-2 punch that folks are not going to be expecting. Now, fortunately, it's not a killer, but it is unpleasant. I'll quantify this a bit more when we jump into the examples. But I really want to warn folks about this, notably because I think people that are most likely to get hit with this are folks taking one-off IRA distributions or capturing a one-off capital gain. And I see this all the time in the real world, working with real clients. People call me up. They're going on a big vacation or buying a vehicle, doing some home improvements. They need to take a big IRA distribution, say 10, 20, 30,000, whatever the number is, can push someone who might otherwise be underneath these key thresholds right into the phase-out range, which results in them paying a tax rate that they unfortunately weren't expecting. Now, for the last part of the video here, I'm going to give you some examples. We're going to look at a sample tax return so you can see the mechanics of what's going on when you break through those thresholds and into that income phase out. All right, let's get into some numbers. We're going to use an example couple. We'll call them Bob and Sally. Here's the composition of their income. Notice we're going to start assuming their baseline income is right at the edge of the phase out for that bonus deduction. So what I'm going to show you here is how their income tax return would look given this composition and assuming that they get the full $12,000 senior bonus deduction. And then we're going to layer on an additional $10,000 worth of income so I can show you how they're getting hit by that 1-2 punch of paying taxes on that additional income and starting to lose the benefits of that senior bonus deduction. All right, let's look at a sample tax return for Bob and Sally. So I'll throw it up on the screen here. Again, this is for tax year 2025. And I've already input all the numbers, the income I just showed you on that prior slide. What I want to focus in on down here when we get into deductions, so they're taking the standard deduction. And then if you take a look down here, notably on line 13B, the additional deductions, that $12,000, that's the senior bonus deduction. So we're bringing their gross income down by a combined $46,700, meaning $103,300 is ultimately what's getting taxed, okay? Bottom line, their tax bill for the year is coming in at $11,712. Next, let's say Bob and Sally called me up and said, hey, we're going on a European cruise. We need $10,000 of additional income to make that happen. Let's take a look at how that would change the numbers on their tax return. Now, before we look at that updated tax return with an additional $10,000 worth of income, let's reference the marginal tax rates for 2025. So I'm going to throw this table up on the screen here, and if you remember from the prior screen, their bottom line taxable income number, so this is their income after deductions, was around $103,000. Well, Bob and Mary are married, obviously, filing a joint return, so if their income's $103,000-ish, we would expect them to be in this 22% federal tax bracket, meaning any additional income within this range is going to get hit at 22%. But as you're going to see, because they start to lose that senior bonus deduction, the tax rate's actually going to be higher. Now, let's look at that updated tax return, assuming Bob and Mary are going to take an additional $10,000 worth of income this year because they got a big vacation plan or something like that. And specifically, we're going to look at how this changes the numbers and gives them some unexpected tax implications. Okay, so a couple things I want to point out on the tax return. Again, their gross income's going from $150,000 now to $160,000, as we can see down here on line 11. And of course, most notably, in the context of our discussion today, on line 13B, this is where that senior bonus deduction goes. It was $12,000, and in their case now it's down to $10,800 because they are in the phase out. They're starting to lose that deduction. So finally, we can see where their taxable income number is. This is their after deductions number and what the tax bill is. In the final section here, I'm going to compare the baseline scenario to this scenario so you can see the strange effect that's going on here, which ultimately creates an artificial and unfavorable tax rate for Bob and Sally. Now, finally, let's reference the tax table real briefly. Remember, Bob and Sally, their after deductions taxable income number in the original scenario was around $103,000. In the updated scenario was in the $114,000 range. So for married couples, that should put them in the 22% federal tax bracket, right? Well, let's see what the effective tax rate actually is on that additional $10,000 of income for them. So to figure that out, we just got to compare the two scenarios. So here's their tax bill, their original tax bill on $150,000 of gross income versus $160,000. So the difference is $2,606. Another way to say this is in Bob and Sally's case, by taking an additional $10,000 worth of income, they're paying an additional $2,606, which of course amounts to a 26% effective tax rate. So to bring this to a conclusion, as you can see, once you're in the phase out, you're paying an artificially high tax rate. Or getting caught in a tax trap is another way to put it, because you're not only paying tax on additional income, but you're simultaneously losing your senior bonus deduction. So I wanted to make this video today because I know that people are going to miss this when they're trying to figure out their quarterly estimated tax payments moving ahead, or figuring out withholding to elect on IRA distributions, Social Security, things of that nature. So I'm trying to help people plan ahead here because there's not much you can do to navigate around this other than find yourself other tax deductions. So anyway, I hope it was helpful. If you got any questions, please drop those in the comment section. I do look at those and try to answer when I can. As always, thanks for watching. We'll see you on the next one.